Well, I think we should see some improvement. We consider we should see some improvement in the second half of this year. There are several signs which are basically guiding for an improvement in the second half. The first one, the most obvious one in our view, is the pickup in the export numbers for the month of May. So this is a very strong sign that finally China is benefiting from the recovery that we're seeing out of Europe, US, but also from Japan, so from the developed world. So that's a positive point. The second thing is that if you look in terms of monetary policy, China has started to ease somehow its policy. If you look at the RRR cut, which of course is specific to a few banks, it's not across the board, but it's a big positive and it starts to work. We will see actually probably gradual announcements, maybe a revision down in the loan to deposit ratio for some banks. What's interesting is that when you look within the emerging world, actually you see a slowdown in the lending rate, in lending growth rates across large numbers of countries, except China, where things are finally stabilizing and potentially could actually improve into the second half. So this is one important point when we talk about China these days, that versus the rest of the emerging world, there is actually an interesting case from a monetary point of view. But at the moment, actually, we've been increasing our exposure to the banks. Considering that the valuation is, I mean, it's been low for a while, that's true, but comes a point where we start to get better visibility as to which banks are going to be affected by any, crisis from the trust world or from the NPLs rising, and it appears that the group of the larger banks are or will going to be relatively okay through the process of cleaning up this whole credit crisis. And so we find the valuation quite attractive. We're buying large banks like ABC, but we're also interested in smaller banks like China Merchant Bank, which is high-end bank in terms of services. We like Minsheng Bank. They're all trading below 0.9, 0.8 times price to book. Return on equity is around 20%. We know it's extremely high. I mean, if you compare to the European average or US average, it has to come down. But, a lot of these negative expectations are already priced in the current book value. I mean, price to book. So we're quite comfortable in those banks. And at the same time, we balance the portfolio with some growth sectors.